Everybody, welcome to our spring 2026 market update. Michael, how you doing?
I'm great. I love this weather. Spring is here.
It sure is.
How you doing?
Doing well, doing well. My son is about to be 7 months old. My daughter's 4.5. It's just a really fun time with our family, and yeah, super grateful, and life's good.
Time flies when you're having fun.
Yeah, that's what they say. Well, Michael, thanks for excited to spend some time together talking to our clients about the market, what's happened, and kind of just what's in the headlines. So, I think obviously the most pressing thing in the headlines is what's going on with the conflict in the Middle East, and I think we just kind of dive in there of what's in the headlines. And this first chart that we have kind of outlines some historical conflicts and how it's impacted investors. So I'd love for you just to talk through this first slide and what stands out to you.
Yeah, it's like uh, a, a daily check to see if the strait is open or is it closed. Like what's going on? It's almost humorous in a weird way how much the news changes uh, day to day. We really like this slide, and for clients and prospective clients, we want to show this to y'all. The very interesting thing about this slide is you've got what 20 or so conflicts going back to 1950, and yet in the bottom right you see the 12-month return uh, in the S&P 500 is 8.5 to 10.7%, which from a median standpoint is pretty close to its long-term return, maybe just a little bit low, which starts to make you wonder, like maybe these conflicts and these wars are not actually driving stock market performance. That's what I gain from this slide. It's like if the average during these times of geopolitical conflicts is pretty close to the average for the last 75-ish years, then there's probably not as much influence from geopolitical events. We see that on this other slide too. So
Yeah, I think that's great. I do think what businesses care most about is, obviously how's inflation going to impact them, how are costs going to go up, which we'll get to here in just a second. But I totally agree. I think that's more what's driving it than some of the actual conflict. But yeah, why don't we dive into this next slide? This one goes back just a little further to World War II, even just kind of showing, okay, based on conflicts, obviously we're not saying what's happening is currently World War II, but just kind of nice to know historically, as students of history, what has happened if you include some longer time frame and look back even further.
that's right. You can always get just some wild differences in stock market returns looking at 1 year periods, even 5 year periods, some 10 year periods. There's some real differences here. But what I really note is on the 10 year returns, you've basically got three of these periods or events that were pretty similar or overlapped very closely to some of the lost decades.
Mm.
A lost decade is essentially about a decade long period where the stock market kind of gives you a roller coaster type feel and you end where you started. In other words, very low to non existent returns. Net a lot of volatility and you netted no money or very little money for a decade. As we've talked about in previous market updates, we get one of those lost decades, about one in every 3.5 decades. So it just so happens that the last one was basically 2000 through '08, and two of the events on here overlap very closely to that decade. One of the events, Vietnam, overlapped very closely to kind of the lost decade that we experienced, kind of mid '60s to mid '70s, where the Dow was really struggling to get past, basically 1,000 points, which we'll come back to that in a minute. So again, I think the takeaway from the data here is that the tail doesn't really wag the dog. As significant as the news is,
Mm.
the market and economy, what's going on, the health of the companies and what's going on in the economy is way bigger and more impactful. Obviously, the market is always attempting to predict mostly the U.S. economy, 6, 9, 12, 18 months out. So that's still happening.
Yeah, I think that's well said. I do think that what's most important to the companies, again, here domestically, they're worried about inflation, they're worried about their cost. I think what is probably most evident to consumers recently has been oil prices.
Yeah.
Price of the pump has gone up a lot, which can impact other things from our supply perspective. So we wanted to share this next chart just about energy producers. So Michael, what stands out to you in this chart, and and why do you think people need to know about it?
Well, first thing is we're the top producer by a mile. I mean, this chart has crude oil and natural gas. We produce 40% roughly more oil than the next two closest competitors or countries. Natural gas is not even worth talking about when you really look at how much we produce just compared to the country that would come in second. It's almost a non. It's almost not even material from a conversation standpoint. Um, so I think that's really important. Certainly, there's some business disruption because obviously we know this, right? Just because the U.S. produces a lot of energy, it doesn't mean that the contracts on that energy are, you can't just tear up the old contracts just because there's a conflict in the Middle East or a war or whatever you want to call it. So there's some business disruption for sure. So it's still not to make it sound like it's, uh, always an easy situation. But if worst came to worst, I think the U.S. would be just fine based on how much energy we produce. So.
Right. Yeah, I think that's well said. Obviously, we feel the short term disruption, but from a supply perspective, it's totally different. And this next slide just goes back to 2010, showing a little more history and with more conflict and how oil has been impacted and the prices. So, what kind of commentary would you add to this chart, and why do you think it's important to know about?
Yeah, it's interesting. Oil has hit around 120 a barrel, twice in the last 16 years. Um, got down to 20 a barrel as well, but again, since 2010, the United States stock market has been in one of these longer term bull markets. We've been through two, almost two good decades because we were just coming out of a bad decade. So again, I think this is a little bit where oil prices are a little bit more of the tail, not the dog. The real thing to be paying attention to is health of the economy, and are we in a long term secular bull market or a long term secular bear market? Again, we've been talking about good decades and bad decades. We think right now we're still in one of those good decade periods, which is why you're seeing a lot of resilience in the stock market. We're uh, filming this mid-late April, and even though we're going to look at some data here in a second that's as of March 31, the market has been pretty resilient in the last few weeks. So I think that's worth paying attention to. It's just important for investors and advisors mostly to understand where are we in the market cycle. Are we in a long-term bear or long-term bull? We'll be in a long-term bear again at some point. We think that's probably around the corner, not right away though. So
Yeah, it's helpful. Well, moving on from headlines, I do want to kind of just talk about what has happened in the market. Again, this next chart we've shown several times, but it's more around volatility. And really, we're just continuing to say volatility is normal. Volatility can mean up and down, and just talking about the intra-year declines. So the data has moved quite a bit since the end of the quarter. But so this is looking at the end of March 31st. There was a 9% intra-year decline, and the market was sitting down about 5%. Fascinating. Even as of today, the market's moved another 8.5% up
yep.
from the end of March. So it has moved a lot. But yeah, Michael, say more about the intra-year declines and as an investor, what may quote unquote be normal and how that impacts their portfolios.
Yeah, exactly. I mean, we harp on this. So you would actually say this is a low volatility year, which sounds crazy to say, but it would be true. Because if the intra-year decline is 9% and our average intra-year decline is 14%, you know, if the Dow's around 50, that means, roughly a 7,000, 7,500 point drop in the Dow would be considered normal, as in annual, once a year. And I don't think as humans we ever get really used to that or comfortable with that, but it's just true. It's that frequent. So technically you would say 2026 has been a low volatility year. It sounds crazy to say that, but it just, it is what it is. The S&P 500 gave us roughly 16% returns last year, 23% the year before, 24% the year before that. So you had to go all the way back to 2022 to get, negative 19% return on the whole year. And so, I think we've probably been spoiled a little bit. Not had a ton of it. We actually had a lot of some volatility, almost a 20% decline about a year ago. But yeah, the market's been pretty resilient. So we'll see how everything shakes out.
And then moving on to just what has performed well, obviously the whole market is not Indicated by the last chart, every asset class is moving differently, and we'll talk about what was the winner last year, what's been doing well this year. But Michael, just walk us through this chart and how even within the large cap space, the discrepancy in returns can be quite large based on a given year.
Yeah, and I might even just walk through. If you're watching along, you can see the returns in the box um, that go through March 31st. And by the way, if you want to ever know, like, hey, what do Kevin, what do Kevin and I, what do we uh, really look at on a regular basis? It's probably asset class returns because we're trying to pay attention to where's the money really flowing in the market.
Mm-hmm.
You can't really predict it. It's not a market timing tool, but you really, really want to understand. You can start to understand how history doesn't repeat itself, but it definitely rhymes, to use the Mark Twain quote. And you can start to really understand where you are in the market cycle. So you can see the March 31 numbers. To update that through kind of late April, large cap value stocks are up 7%, small cap stocks are up 11%, international stocks are up 6%, bonds are basically flat. The S&P 500 is up about 4%, and large cap growth is about flat. So what you're seeing this year is value stocks outperforming growth stocks in the large cap space. Bonds had a 3% decline. Now they're flat. So bonds are being bonds, some volatility, but not much. And then you're seeing small cap outperform everyone in terms of major asset classes, which nobody really would have predicted that, which is why you always have to have a certain level of humility with your predictions.
Yeah, absolutely. Yeah, small cap may be getting a little bit of relief from potentially interest rates coming down, which they've started seeing a little bit of that, but maybe not to the extent that most people have thought. Well, this next chart is really fascinating. I kind of love looking at this because it kind of shows from year to year by sector how difficult it is to see what moves. And what will stand out is just the volatility from 2025 to year to date. You can pick on some of these really quickly, like that have performed really well, like technology. Technology was one of the big winners last year, down this year. You can look at energy, really down last year, up massive this year. So Michael, just talk through like the struggles as an investor to understand this sometimes, how people cannot consistently forecast this perfectly, and how diversification helps a portfolio.
Yeah, you have to be really careful with, especially sector specific ETFs. We're certainly not opposed to them. We utilize a lot of them with clients. You just have to be very, very careful.
Mm-hmm.
It can almost be like stock picking. And so, again, the sectors are very, very almost impossible to predict. You certainly, if you're managing a portfolio, you want to be buying low, selling high. But to predict that financials would have such a huge swing downward, energy would have such a huge swing upward, technology looks like it's a huge swing down on this chart, but has recovered very, very nicely as things have maybe starting to appear like they're under control in the Middle East. So this is one of those charts where it's kind of like leave it to the professionals. Not to sound arrogant with that, you certainly have to have a lot of humility, but it's important to stay really diversified. So
Yeah, that's great. I think one thing that's pretty fascinating that we look at is from a historical standpoint. I just wanted to hit on this because the Dow actually has hit a new milestone of 50,000 recently.
yep,
It wasn't too long ago that we were celebrating when it hit 20,000, 40,000. Here we are at 50,000.
yep.
So we just love some of your thoughts as somebody who's been in the business for 20 plus years. When you see Dow at 50,000, you just mentioned it wasn't terribly long ago that it was at 1,000. So
Yeah.
talk through, reflect a little bit with us on what that feels like to see the Dow now at $50,000 and how that was ultimately achieved.
Yeah, I mean, it really did take roughly a decade. I would have been born in the late '70s, kind of on the tail end of this, where the Dow was like trying to break through 1,000, and it struggled for many years to get there. And then here we're sitting at 50,000. I remember a cool story. This would have been in as the market was going down in '08. Probably my first got into the business, wealth management investment business in '05. So still kind of in my first few years, and was talking with a client about some volatility, some concerns she had about volatility. And I simply just stated, I think the Dow will hit 20,000 before it hits 6,000, which was kind of my way of saying, the Dow at that point was probably at 12, coming down to 10, going down to 8 pretty fast. And it was my way of encouraging her that, I don't know when it'll hit 20, but there will be a bottom here. Um, and she kind of looked at me funny, kind of like I didn't really understand what she was concerned about, but I reassured her that, hey, even in her case, I remember she was getting ready to retire in the next 5 years, that, her life expectancy was still 2 or 3 decades, and that she needed to be thinking about Dow 20,000 more than she's thinking about, the Dow being at 12 that time and going down to 6-ish or that range. And so I think she got the point. Now 20 years into my career, we're sitting at Dow 50,000, and we actually were just before we uh, recorded this, we were looking at um, a market update we did actually exactly 5 years ago about the components of the Dow, and there's really only like a handful of stocks that were in the Dow 50 years ago that are in the Dow now. So the huge majority of stocks that make up the Dow Jones Industrial Average, it's like, where's International Harvester Company? Where's Chrysler Corporation? Where is Eastman Kodak? Um, these companies, where is Sears Roebuck and Company? These companies that were in the Dow 50 years ago are not in the Dow anymore. And you see some that still are. You got 3M, you got Procter and Gamble. But the beauty of the Dow is that there's just a rotation effect to it. And as we'll talk about here in a second, you always need to be kind of floating on top of what the indices are doing. You can never, as an investor, never let your portfolio get pulled down by having the wrong stocks. You'd rather almost have like all the stocks than have the wrong ones, because if you have all the stocks, you'll have the right ones too. So we'll get to that here in a second. But I just think it's a fascinating thing. You've never really had a time in history where you could just say, hey, these 5 to 10 stocks are really stable, and I'm just going to roll with these forever, and I'm not going to have to worry about anything. I would argue that you don't have to worry about anything as long as you stay much, much, much more diversified than just 5 to 10 stocks. So
Yeah, I think that's well said. Some of that, even as you said, telling the story, it's like we got to be thinking about playing offense a lot instead of just defense.
that's right.
And the clients that want to play defense are really sometimes of course we want to be enough conservative enough, but we have to be worried about missing out on the upside.
That's right.
And so I think staying humble enough to admit we don't know, and so I think that's why watching the Dow move from 20 to 40 to 50,000 is pretty fascinating.
Yep. Yep.
So well, this next chart that I want to share is around business valuations and how it impacts the S&P 500. Something that we're looking at a lot. We looked at last quarter. So Michael would love just an update from last quarter to this quarter on some movement that we've seen and your thoughts on this chart.
Yeah, it's a little bit of same old, but there have been some things that have changed. Listeners to these updates, or viewers of these updates, will find it familiar that we keep saying the market is priced fairly high, but not too high. That's just our opinion, our view. What we mean by that, and if you'll kind of direct your eyes to kind of the far right section, obviously, well, go back even kind of to the middle, or just to the left of the middle. If the market was trading at 10.4 times earnings on a forward-looking basis, that just
Mm.
means that if a stock was going to have allocated to it $1 of earnings uh, uh, per share, that the stock price would trade at $10. Right? That's a price earnings ratio. $10 price divided by earnings. 10 divided by 1 is 10. Um, that's a very low valuation in early '09, March 9th of '09, when the market bottomed out. Um, and then you fast forward the next indicator on this chart, the market was priced at 19.2 on a 12-month forward-looking price divided by earnings ratio basis. But the S&P 500 was roughly at 3,400. And so was it overpriced then? Well, what about when the S&P 500 hit 4,800 in January of 2022 and it was trading at 21.4? Was it overpriced then? Well, now it's trading at 6,500 as of the end of the quarter, much higher since then, now that it's mid-late April, and it's trading at 19.7. So the last several markers are all pretty high price earnings ratios, and yet the market just keeps climbing. There is a historical precedent for this. It would be on the far left of this chart. It is what happened in the 90s, especially in the late 90s. So
Mm.
you don't really ever know when the market is going to top out and the beginning of a bad decade comes. You have to have a certain level of humility with that. but you can make some tweaks in the portfolio like we do for clients as you get closer to that next bad decade. So this is just something that we'll continue to watch closely. We won't be able to time it perfectly either, but there's a lot to be gained by just kind of knowing the season that you're in the market.
That's great. Well, I think one thing, Michael, I always enjoy is we're able to, obviously we spend a lot of time together talking about maybe what you're reading or what I'm reading or researching or listening to, with all the different formats of podcasts and Wall Street Journal, whatever it may be. But I'd love for you to share maybe just 2 things or 3 things that you have read recently that you just kind of wanted to share that stood out to you.
Yeah. Um, One thing that I just did not know, we saw this in the Wall Street Journal in last month. It says for the 100 years since 1926, the U.S. stock market has returned about 10% annually. We did know that, but only 3.4% of the stocks were responsible for all the wealth creation. The rest of the stocks combined did not produce net gains that exceeded the amount that could have been earned from investing in 30-day U.S. Treasury bills. And more than half the stocks in the market lost money. The generous average return from the market came from a tiny handful of stocks. It's just really, really important. It's kind of what I was trying to say a minute ago. You cannot let your portfolio get pulled down by the wrong stocks. And oftentimes it makes more sense to be diversified so much so that you make sure you actually have this 3.4% of the stocks. The Dow hitting 50,000, the Dow 50 years ago is night and day different from the Dow now. It's not even the same group of stocks, So I just think it's really, really important. Innovation is a big deal. We talk about it on this next slide. AI is like all in the news. We could do a whole market update just only devoted to AI. But I like what Larry Fink, the CEO of BlackRock, said. He said investing is the best hedge that Americans can make against the predicted economic disruption wrought by advances in AI. History suggests that transformative technologies create enormous value, and much of that value accrues to the companies that build and deploy them and to investors who own them. So, like you said before, Kevin, we just have to remind ourselves that, we own companies and not stocks. It's so, so, so important. If you could go back into the late 90s, and you could predict the future, you would have said, how can I buy internet? The internet is going to change our lives, right? If you're kind of sitting there and it's 1995 or whatever, and it was already beginning, right? How would you own that? Well, you would buy companies, not only internet companies. The internet benefited some, their technology companies would have been good to purchase, but they went like straight up in the late 90s, and then they went kind of straight down in the early 2000s. The best way actually to profit back then from the internet that was coming would have actually been to stay diversified, because the internet was going to kind of help all successful companies, the ones run by the best and brightest business minds. They were going to figure out how to leverage the internet to help them achieve a profit for the shareholder. AI, in our view, as you know, AI to our clients and prospective clients, AI needs to be viewed exactly the same way. It will change the way we do life. It is changing the way business is done, but you don't have to have all technology stocks, and we would never really recommend that. AI will be leveraged the best ways by the best and brightest minds in business, and owners of diversified portfolios will see those profits accrued to them through essentially earnings, which will affect stock prices.
Yeah, I think that's great. I think that's even the volatility we've experienced this year. It's a good reminder that we own companies, not stocks, right? I
Yeah,
think companies were trying to figure out, based on the Middle East conflict, how that was going to impact them. And I think for a short period of time, people thought, well, inflation is going to be higher, supply is going to be short, so costs are going to go up.
right.
We've seen that not play out. Things maybe are going to be shorter than originally predicted, and that's why we've seen the rebound so fast.
Yeah,
So I think just a good reminder that as things are volatile, it's continue to ask ourselves, okay, how does this play out for the companies? And that starts to give us a little more peace of mind, knowing it's not as complicated potentially, even though on a day-to-day basis, we don't know what's going to necessarily drive the stock market.
no, you're exactly right. It reminds me of, it was probably about 2010. We were a couple years, the market had been probably recovering for about a year after '08, early '09, bottoming out in early '09, like we said a minute ago. And I was actually talking with a fairly successful entrepreneur type who had invested some money, and he said, very confidently, the market doesn't trade on fundamentals anymore. And what he meant was the market does not trade on earnings. The value of what he was claiming is that a stock price does not make any sense given that company's profits. And yet in this chart, we see that there can be some diversion between the stock price using the S&P 500
Right.
and the S&P 500 earnings. There can be some diversion at times, but if you look at the navy line and the lighter blue line, they basically move together.
Yep.
I knew enough in 2010 to tell him that that wasn't true. That the stock market will always eventually trade around earnings. It's never as predictable as we might like for it to be, and I think that's what he was trying to articulate.
Right.
But the important thing is that we're buying companies, we're not buying stocks. We are shareholders and investors in those companies, and as long as they are profitable, we will probably never get the predictable same annual rate of return that we would like to have, but we will get it, and we call it average for a reason.
Yep.
So,
It's great. Well, I think let's move to this next chart. We haven't shown this in a long time, but kind of the theory that, or the reason we're showing this chart, Michael, is something along the lines of, let's control what we can control. One of those things is taxes, and so I
yeah,
think just obviously this would be portrayed to a taxable account, nothing to do with qualified accounts like IRAs or 401ks, Roth IRAs. But
yeah,
let's just talk about a little bit about capital gains and what sticks out to this chart for you.
yeah. It's tax time, right? So we thought it'd be really good to have just to touch on taxes. There's a few things that investors really need to be thinking about to get their money to work as hard as possible. You just mentioned one, tax shelters, right? Tax shelters need to be maximized if you're still in accumulation phase. If you're in distribution phase, then it's just as important to understand which account do I need to be pulling from each year to lower my taxes this year, but also to have a view that lowers my taxes over my lifetime. And that's something we obviously do for clients. Um, uh, we create essentially custom tax strategies for them on an individual basis because every tax situation is different. For a taxable account, you're looking at things like tax loss harvesting, but you're also looking at essentially what this slide is showing, which is just like, for example, in 2025, what is this basically showing? Capital gains by investment vehicle essentially means, like, for active mutual funds in 2025, the average active mutual fund distributed a 7% capital gain. What does that actually mean? That means 7% of the fund was returned to shareholders in a taxable event. Okay. The average ETF returned a capital gain as well, but it was under 2%. So what's happening here? ETFs and mutual funds are there's some differences obviously, but for the most part are pass-through entities. Taxable events have to be, or taxable activity has to be passed through to shareholders. For uh, an active mutual fund, there is just simply more turnover. That turnover results in more taxes that gets sent to the shareholders. So in a taxable account, why are you benefiting from having a lower capital gain passed through to you? Well, there's two reasons. One, it's less tax, it's a lower capital gain, so less money out of your pocket this year. But also in a taxable account, as many of our clients know, for any money that you don't use while you're alive and then at your death goes to your beneficiaries, those beneficiaries, most of the time in a taxable account, get what's called a cost basis step up. So if someone paid 50,000, put 50,000 in an investment account and it grows to 300,000 over their lifetime, that $250,000 gain, if they don't touch it, for the most part, that cost basis comes up to 300,000, and that $250,000 capital gain is essentially forgiven at death. So capital gains by investment vehicle, like you said, Kevin, is a really important thing under the category of, like, control what you can control. Taxable investment accounts need to be managed with a lot of tax sensitivity in order to get that money to work as hard as possible. We say it to clients all the time. It's not about what you make, it's about what you keep. Both are really important, but we want the net after tax number to be as high as possible. So,
Yeah, I think that's well said. And for our clients, we have the capability to manage all this, client by client to be as tax sensitive as possible, because that's really what we're always grading. It's not about the gross return; it's about the net return, or it's not about what you make, but about what you keep. So I'm glad you brought that up. Well, this one last chart, Michael would love to put this one back on the screen. It's about our process and what we think is most important, but would love to just talk about a little bit why we think this is important, how we think about it for our clients, and what's really where the portfolio ranks in relation to a financial plan or the clients that we serve.
Yeah, and it makes me think about a really cool project. Good friend Brian Barley and I started a podcast this year. It should be coming out soon. We'll make sure everyone gets notification. But it's called The Heart of Money. And this is where we really take a deep dive into you can have made all the smart investment, insurance, financial, tax, estate planning um, decisions possible, and that is like half of the puzzle. That is so important. And that's what you usually get when you go to any, well, not any, but the really good financial advisors out there that do wealth management in a comprehensive way. And why would we say that's half the puzzle? Because that's half the puzzle is kind of like, personal finance is 80% personal and 20% finance. So I could say that's 20% of the puzzle. And it's really, really important to minimize your taxes, make sure your estate plan's buttoned up, your portfolio is managed tax efficiently, all those things. But if that was kind of the head, then what we're talking about in this podcast is essentially the heart. And the process of really like, what does person plan portfolio really mean? It just means like, what are you really trying to accomplish? Not from just a numerical financial standpoint, but what are the reasons why? And there's a process, and Brian and I talk about our process that we go through in a lot of clients and review meetings. Sometimes we don't have time to touch on it every single meeting because there's a lot of tax and investment items to cover. But but it's really important to understand not what your goals are, but what's your what for. What is the reason you feel continually and consistently compelled to reach their goals? There are deeper reasons. That awareness can bring like a lot of freedom, because achieving an outward goal like a financial goal brings a certain level of satisfaction and fulfillment. But knowing the reason you're pursuing that, there's a whole nother level of satisfaction and fulfillment that's possible. I think it was years ago. It dawned on me that some of our wealthiest clients, as much as we love them, they were not always the clients with the most financial peace. And so if our wealthiest clients did not automatically have the most financial peace, and it doesn't mean they were the most anxious either. It just there wasn't always really a correlation. And so then it really can't be about money. And this is no excuse to not, we still want to manage money with kind of like an OCD focus on how hard it works for us.
Right.
But there's a limit to that. And then everything beyond that is really gifts of the heart that we think are available to us. So check out the podcast. We'll send some updates about that. But I'm really excited about that, and just really glad that we on our team we stay really focused on helping clients understand what their deeper purpose really is. Let's create a plan that accomplishes that purpose and puts them first, right? And then let's manage portfolios that can accomplish the plan that we've set out and teamed up with them on. So really excited about that, and excited about that project. Yeah.
Yeah, I love that. I'm anxious to hear it now. So it sounds exciting, and I haven't even heard it myself. So I'll be looking forward to hearing about what you and Brian have been working on, and yes, we'll get that information out to our clients, which would be great. So,
Yep.
well, as we wrap up, just wanted to say, you know, thank you for listening. We appreciate you letting us serve you. It's a true partnership, Michael. It's an honor to get to do this with you and to be able to serve all of our clients. So, thank you all. If you have any questions, please feel free to reach out to us or email us at Sage or Purifoy Wealth Team at sagespring.com. Thank you.